I think the first misconception or the first area of confusion usually is actually based around what even is a private investment in the first place. So most investors or most individuals, when they begin getting exposed to investing, are dealing with the stock market, mutual funds, exchange traded funds, individual stocks or bonds. And all of those types of investments are typically structured and available through the public market, traded on the stock market. So what that means is you as the investor or are buying or selling something that you can then turn around and buy or sell on that same market the following day. By being publicly listed, all of those investments also undergo a annual audit and they're providing quarterly information updates with the goal of ensuring all market participants have access to the same information. So companies, you can buy and sell them all the time, and there's lots of information available about them. Private investing as a whole, before you even talk about an individual project, is extremely different. You're investing in, as the name says, an individual private offering that is not available for trading publicly. It's not necessarily providing ongoing audited financial statements and quarterly updates. So the information access is reduced and the liquidity opportunities are reduced.
Most investors don't realize that at least 50% of the investments that high net worth individuals make are in private equity and real estate. The public markets form less than 50%. Most people don't know that in order to achieve higher returns, it does have some higher risk, but most of those risks can be managed with the right project, the right sponsors, the right approach. People have to make their own assessments of those and look at their risk profile, but private investments offer the potential for a significantly higher return.
You certainly raise a very good point there, Denise, about the private markets. Now, historical returns are no indicator of future returns, but historically, the financial markets, the private markets, have been able to generate higher returns than the public markets. Again, with no guarantee of that continuing in the future, but certainly we do see a lot of individuals looking to diversify their investments with the idea being, okay, if one area is not doing as well, hopefully I'm in a different area that's unrelated. And so it will either not do badly or will do well when one is doing not so well. So typically we see people who are in the public markets look to diversify some of their investments and also hold some investments in the private markets as well, just to have a more balanced portfolio. One common misconception is around the term financial advisor. Financial advisor with an E is a legally regulated term where someone actually has to provide advice in the best interest of who they're talking to. Financial advisor with an O is a title unrelated to any legal requirements put on the individual with said title. And so many of the larger financial institutions, their team of financial advisors are only allowed to sell investments, mutual funds, ETFs, things like that, that are created and owned by that same financial institution.